Did you know that 80% of all commercial real estate loans are done by small and mid-sized banks? I mean, wow, right? Well, in this video, I'm going to discuss how high quality office space is coming under pressure and values are falling because of high interest rates, the pandemic, and the work from home movement.
Best of Us Investors presents Kerry Griegmeyer.
For the last 4 hours, I've been trying to shoot this video. I've been trying to follow a script. I've been trying to do it just by the book, but I've been struggling and I can't put it together. So I'm just gonna wing this one for you. I'm gonna give you a bunch of facts, but more importantly, I'm gonna give you an idea what to do at the end of the video to help protect you and your assets. The pandemic basically changed the whole commercial real estate world. And the reason it did was because everybody started working from home. So these high-end, high-quality office spaces in big cities such as Los Angeles, New York, Miami, all over the country, all over the world, all of a sudden became vacant to some level. And over the last 3 years since the pandemic, we have seen a work from home or work at the office sort of choice kind of being offered. Well, a lot of these companies have come under enormous revenue pressure because we're entering, or in my opinion, are in a recession. And what that's doing is their biggest expenses are one, the employee, and two, where they house them, their office space. Well, now we're starting to see cracks in the foundation of the commercial real estate market. For instance, Brookfield Asset Management defaulted on a mortgage on 2 buildings in Los Angeles, equaling $750 million. There is many more other commercial real estate properties that have come under pressure or are on the verge of default or have defaulted because of the rise in federal funds rates over the last 12 months. Understand a commercial loan is different and structured differently than a residential loan. Yes, you could have a duration of say 20 years on a commercial loan, but in that period, you could have adjustments on that rate. Well, in the last year, we've seen prime go from basically nothing to 8% today, according to the Wall Street Journal. Well, if your rate exchanges on your commercial real estate loan, you're going to end up paying more in a monthly payment to own that property. Well, some of these loans are 5-year or 7-year term loans, and they have a payment plan, and then at the end of the term, they have a balloon payment. Well, for a lot of these companies, they're coming under revenue pressure, so they don't have as much money coming in as they did, say, a year ago, 2 years ago, 3 years ago, 5 years ago, and now they're having to pay more for the real estate loan or the commercial real estate loan that they have, and their balloon payment is coming, and they don't have the money. So we're starting to see more and more defaults in the commercial real estate world. What does that have to do with small and mid-sized banks? Well, since they do 80% of all commercial real estate loans in the country, and probably in the world, you're seeing a lot of these loans getting reevaluated. And as we see Signature Bank, who failed a couple weeks ago, and the FDIC is now telling them, or issuing I think it's Newmark Group, they're taking those commercial real estate loans and they're selling them off into the marketplace, which is going to cause a revaluation on commercial loans on these banks who hold and offer commercial loans, which is going to reevaluate that value. So it's going to mark those loans down potentially, because chances are those commercial loans that Signature Bank had are probably not as good and probably aren't going to get a dollar for dollar for what they are. So basically, you're going to see a bit of a fire sale on commercial real estate loans, most likely, which is going to cause the values of all commercial real estate loans to be reevaluated, which puts enormous pressure on small and mid-sized banks. Now, what I have research I have found is Wells Fargo is one of the biggest holders of commercial real estate loans. They, I believe, represent $36 billion in commercial real estate loans. That's an enormous amount of loans that could be revalued based on this Signature Bank commercial real estate fire sale they're having to put on because it's issued by the FDIC. So here's where my concern is as we proceed forward into the year. One, the Fed's going to raise interest rates in May, probably about 25 basis points. The Fed overshoots it every time, right? They overdo it or they underdo it. They underdid it on the pandemic. They overdid it on the financial crisis and drove Fed funds rates down to zero. And basically, if you bought a house in the last, say, 3 years and you got a mortgage, you probably are paying less than 4% on that mortgage. Well, 70-80% of all real estate mortgages in the country have been refinanced in the last 3 years. So that whole market for banks on refinances is going away. Unless you need to refinance because you need to pull equity out of your house because you got over your head maybe, or you're just willing to pay a higher rate to get the equity for the opportunity potentially to buy real estate at a cheap rate, you're not refinancing your house, and most people aren't. Well, look at the commercial real estate environment. You're a business. Here's my business plan, Mr. Bank. And they look at it and go, okay, well, prime right now is 8% versus, say, 12 months ago. And it was, I believe, below 3% at one point. Correct me if I'm wrong, but it was much lower than it is today. The bank looks at the business and says, well, actually, your revenues are dropped, your earnings per shares are dropping, your industry is basically slowing, and unfortunately, we can't offer you a good rate. And the rate we could offer you is 8% plus, and maybe minus a little bit. So this puts a lot of these businesses who are holding commercial real estate loans, and then it puts the banks in a lot of, basically in a corner. And so what I believe is going to happen is that you're going to have a lot of these businesses who set up these loans on these buildings as separate entities. Okay, they typically do not own their real estate in the same company. So if I'm a XYZ business and I manufacture widgets and I'm a multi-billion-dollar corporation and I need a factory or I need office space in New York or Los Angeles or LA or downtown Birmingham for some reason, I'm not going to hold that real estate in my company name, but rather I'm going to set it aside as a separate entity that my corporation potentially owns, or some subsidiary of my parent corporation. Well, if I can't refinance that loan because I got a balloon payment coming up, my revenues are dropping, guess what I'm going to do with the keys to that building? I'm going to walk into the bank and I'm going to hand the bank the keys to the building and say, we're filing bankruptcy with that corporation. Here are the keys. You own it. You just foreclosed on me. And I see potentially that accelerating as we get into the second half of the year. This is going to put enormous pressure on the commercial real estate loan segment of the banking world. And remember, 80% of all commercial real estate loans are done by small and mid-sized banks. So the trick is to figure out if your bank is a big lender of commercial real estate, and if they have a lot of loans coming up for basically due, and are they going to be able to refinance those loans, those corporations refinance those loans with your bank, or are they going to end up turning around and saying, we don't need the office space anymore, here are the keys. And your bank's basically holding the bag. This happened before in the financial crisis. It was in real estate, residential real estate. Today, it's in commercial real estate. And it's a bigger chunk of money that we're talking about. This could put enormous pressure on the earnings reports as we see first quarter earnings come out, second quarter, third quarter, and 12 months from now. Banks they're under a microscope right now. And if you're investing in the financial, banking world, you need to evaluate what you're holding and what those companies are. Second, let's expect that the Federal Reserve will actually pivot at some point, or at least stop raising rates. Well, what is that going to do to the overall market? Well, the market's going to look at it and go, oh, there is a problem, and it's going to react. And what you potentially will see is a move out of equities, out of stocks or high risk assets. And one of those areas that are high risk right now and are subjected to the Fed raising rates is the banking industry, is the lending industry. So where do you put your money? How do you allocate your money? Well, this past Sunday or Monday's video on Best of U.S. Investors, Kerry, Mark, Drew, and I talked about where money is flowing and where the safe place is. In that video, we discussed where money is flowing. Right now, it's been, over the last couple of weeks, it's been flowing out of deposits and moving towards U.S. Treasuries. Short-term debt, such as 3 months, 6 months, even 2 years. Because you can get upwards of 4 to 5% on your money in assets in U.S. Treasury T-bills or U.S. Treasuries versus your checking account and banking account. Second, the credit quality of the United States is, well, it's better than pretty much every bank. They're going to most likely pay out on those that interest rate on those U.S. Treasuries. So if I'm holding cash right now and it's sitting in my bank and I have an enormous amount of cash, I may just want to allocate a portion of that asset to short-term U.S. Treasury bonds. Now, this isn't a recommendation or advice. I do recommend you go out and you do your own due diligence. Do your due diligence on your bank, do your due diligence on the business that you work with, or if you own a business, on your banking relationship and what the solvency of your bank is. But also to understand, this is one of the biggest bubbles we have ever been in because of the amount of leverage that has been taken on over the last 12 years since 2008. And now it's starting to unwind. So the question is, find pristine capital. What is pristine capital? U.S. Treasuries, high-end corporate bonds, companies that we are going to have to use and need if we enter a deep, deep recession. That's my thinking. That's how I'm allocating. If you follow me at qqqtrades.club, that's qqqtrades.club, and you subscribe, you're now seeing an asset allocation model that I've put together based on the economic conditions of this market. It isn't out there to blow the doors off, and it's not a day trading approach, but it's a risk management approach to take advantage of opportunities in the marketplace, even if you're in a bad economy or a great economy. I adjust it on a regular basis based on what's happening, but it's not day traded. So if you're looking for something and you're looking for guidance, check out qqqtrades.club. Yes, that's a website. It's actually a website like .com, but it's .club. qqqtrades.club. Check it out. I look forward to your thoughts on this video. Please hit the subscribe button. Please follow us at Best of U.S. Investors. And remember, this is educational, not advice or recommendation. Please do your homework, do your due diligence, and protect your family's wealth. Live loud.